We're here to talk about 20 micro markets in Silicon Valley and 12 different metrics that we're going to be looking at. We're going to start off looking at some key indicators, then we're going to go over to Silicon Valley as a whole. Then we're going to compare the 3 counties within Silicon Valley. Then we'll go over the data table, and finally we'll do an introduction, and then the greater Bay Area, which is 13 counties in Northern California. So let's start off with, down the left-hand side is your 20 different micro markets. You have Santa Clara first, then you have San Mateo County in the middle, and then Alameda County follows up on the end. The 12 metrics we're going to be following are on the top: active inventory, offers accepted, days of unsold inventory. These are all compared to the 10-year median. So you can see if the market's doing hotter, cooler, or completely normal compared to the past 10 years. And then we look at days of unsold inventory compared to just now, marketing time, which is how long it takes 75% of the sellers to sell. The seller price adjustments, both the magnitude, which is the amount of the adjustments, and the frequency of the adjustments. So how many sellers are actually adjusting their price before the offer comes in. Then flipping over and looking at the buyers, the size of the overbid, the magnitude of the overbid, the frequency of the overbid, the appreciation since the last 9 months of 2015, and then the median price in the middle, and the 10 percentile and the 90 percentile on the end. So you have the sandwich for each area, and then an estimation of the principal, taxes, and insurance payment, the total PITI payment. See, it's the 10 percentile payment, the median in the middle, and the 90 percentile on the far right. And that's using a 30-year fixed, the national rate average. So let's get in and look at the first key indicator. The key indicator here is a distribution of days on market. This is how long it's taking the sellers to sell the property in 3 quarters. So 25% of the sellers are selling their property down here in something like, looks like about 7 days. 50% of the sellers are selling in about 11 days. 75% of the sellers are selling in something like 26 days. And then 90% of the sellers are taking 54 days to sell their property. This is something no one has control over, really. You have to be lower on your price, but this is the market indicating what that balance is. A year ago, we were on this blue dotted line down here. Currently, we're at the purple dotted dashed line, which clearly indicates we're quite a bit slower than we were just a year ago. In other words, a year ago, 75% of the sellers were taking something like 16 days to sell their property. Now the same 75% of the sellers are taking 26 days, 10 days longer. That's pretty significant. We're going to start off on the blue dash dotted line here. Then we're going to adjust basically a month at a time. And I don't do anything on a monthly basis. So it's either 4 or 5 weeks, trying to keep as close to the 30th of the month as I can. So you have the 27th, and you have the 1st, and you have the 29th. And that just gives you an idea of what the market will be doing. So even though we're on the purple line currently, the blue line and moving forward will give you an idea which direction the purple line is most likely to go. So let's get going. You can see the movement there a little bit. Now it's up, and it's clearly slowing down. So basically between now and the end of the year, you would expect our current purple line to be slowing. That's the peak of the year right here. Now you're already starting to slow down. So the peak of the year was basically somewhere around, in this table, it's going to be May 3rd, but it was actually April 16th or April 29th, right in that time frame, depending on what metric. And you can see that right now, the solid lines here have been fairly stable with some bouncing, and we've actually improved for the last 3 weeks in a row. Very small improvements. It's basically fluctuations. That's one of the key things with statistics. You want statistics that tell you what the market's doing, not just numbers, because if you have a number that jumps around a lot, it really doesn't tell you what the market's doing. The key takeaways are we're slower than we were last year, and most likely going forward between now and the end of the year and even into January, this metric is going to take longer and longer for the sellers to market their property. Now looking at price reductions, these are the price reductions that the seller has to take to get their offer in. The concepts are exactly the same. The blue dotted dash line here is where we were a year ago. The purple is where we are now. Basically, sellers are taking larger reductions. Now, it's a small percentage of sellers that take price reductions. You can see even right now, only 17% of the sellers are taking price reductions, because at 17.5%, you're basically at zero. But now this year, instead of at 12.5% of the sellers are taking something like a 4% price reduction, where a year ago, that same number of sellers were still taking 0% price reductions. We'll start off and we'll see the movement from the blue line. So you can see again, it cools off at the end of the year. And then right at the beginning of the year, it races up. You can see, and there's the peak right there, which is at March 29th. Again, it's really April 16th, but because of the calendar, I don't have that data point on here because I don't want to go through 53 weeks of this, and I'm already going probably through too many. But again, you can see some stabilization here on price reductions because there's some bounce. And the current line, the purple line right there, is actually the lowest we've been. Right now, sellers are taking the most price reductions as they have had this entire calendar year. And talking about calendar years, my real estate fiscal year that I do all this data starts on March 1st. And that's because there's only 364 days in 52 weeks. We have 1 or 2 extra days every year. So with leap year having a discontinuity on March 1st, I decided to make my discontinuity there. So I go start March 1st, jump forward 7 days at a time, get all the way around to February 21st. And instead of jumping forward 7 days, I jump forward 8 days on a normal year, 9 days on a leap year to get back to March 1st. There's a disadvantage of doing that, and that is the day that I look at my inventory changes, but it's the least of the evils. Now we're looking at overbid. So this tends to be delayed because you need the sale price to know where the overbid is. And here you can see the purple and the blue line are basically on top of one another. So the buyer's overbidding is the exact same level basically this year as it was last year. You also will see that it bounces around a little bit, but basically the trend is going to be down for the balance of the year. That's the bottom right there. Now you can see you race up fairly significantly. There's sort of the peak, May the 3rd. And now you're going to be coming down pretty much for the rest of from May 3rd all the way up to today, August 30th. And you can see the slow drift down. This is a little bit more stable of an indicator just because escrows tend to close at different lengths. And there's the current data. So we're basically right on top of where we were last year compared to the amount of buyers overbidding. And this helps buyers out quite a bit because they can come out here and see that 10% of the buyers are overbidding by 18%. Half the buyers are overbidding by around 5%. And when you look at this at each micro market area, it really gives you some indication of what's going on when you're trying to make an offer on a particular house. Now we're looking at the metrics in all the different areas. So there's 20 micro market areas here, although for the first 3 slides, I have Alameda County as one micro market area. What we're doing now is we're comparing the number of active listings compared to the 10-year median. We go back 10 years to the same date. We look at what that inventory is. We take the median of that and compare today's median. You can see that a lot of these numbers are pretty close to 100%. And when I say close to 100%, I'm giving them about a 12% leeway on either side. South County's at 98%. East San Jose at 76% is below that. So it's a little bit pink. The pinkest area is the most shortest inventory is the Campbell, Santa Clara, Willow Glen, Cambrian area. Now, yes, Foster City up here is actually pinker, but the reason I didn't mention that one is Foster City, Redwood Shores is a very small micro market area when it comes to single family homes. And it's unique, which is why it's not included with Redwood City or the Bay cities, but it's there. It gives you an idea of what's going on, and it's only got less than half the inventory that it typically does. The area that I'm picking up the most area right now is San Mateo County Coast at 111%. Doing the same thing with offers. Here you can see a shortage of offers because these numbers are all below the median. The only exception to that is Los Altos and Palo Alto at 107%. Every other area is less than where it typically is. Fewer offers favors the buyer, which is why we're blue in color. Basically, the offers are more blue in color than the lack of inventory was red in color. Now we're looking at days of unsold inventory. This is the ratio between the inventory and the offers. And you can see most of the area is basically white in color. The few exceptions are down here in South County. And then the expensive areas in Redwood City in San Mateo County. They're only about 35% above where you typically are, because days of unsold inventory, the longer the days of unsold inventory are, the slower the marketplace is. So 25% in the case of South County, 35% roughly in San Mateo County. Foster City is actually fast paced, mostly because of the lack of inventory at 54% of where it is. So twice as fast as it normally is. Most of the valley is right around normal. You can see the Alameda County is at 97%. Santa Clara County is basically right around, I would maybe pick 95%. It's hard to pick a number on the fly, but you got several right at 95, you got 88, you got 102, and you got the 124. And it depends on how many listings there are in each area at the given time. Now we're looking at days of unsold inventory. This is just the raw count versus compared to the 10-year median. So this is just based on my normal metric, which is the tables down here from 1 week to 6 weeks favors the seller, because that's a fast-paced market. From 6 to 11 weeks is a normal marketplace, and above 11 weeks is a slow-paced marketplace. You can see most of the area is fairly fast-paced. Even over on the San Mateo coast is fairly fast-paced at 68 days. The only slow area right here is the expensive areas in San Mateo County at 127 days. That's taking 4 full months for us to sell out all the inventory at the existing rate of sales. This is a metric I've added on for the consumer that doesn't like statisticians playing around. It's simply, how many days does it take 3 out of 4 sellers to sell their properties? You can see in Santa Clara County, the heart of Silicon Valley is basically right at 16 days. That means in a little over 2 weeks, 3 out of 4 sellers are selling their properties. Yeah, there's areas like South County and East San Jose that are higher at 42 days for South County, 33 days for East San Jose, and even Saratoga Los Gatos at 22 days, Los Altos Palo Alto at 19. But you can see that, they're fairly fast paced. Most of the numbers are around 20 days, right around 3 weeks. And that's why there's a fair amount of pink on here. There's only one area of blue, and that's the San Mateo County coast. Looking at price reductions. So these are the amount of price reductions that the sellers have taken. And this is on average. This is a very tight metric. In other words, these numbers don't vary very much from zero. They're going to usually be negative. They do sometimes go slightly positive as hard as that means, which means on average, sellers were raising their price. And that happens in very exceptionally hot marketplaces where sellers raise their price typically to cut down the number of people coming through the properties. You can see that they're mostly a shade of blue here, but these percentages are fairly small, 1.5%. Why is 1.5%? And that's one of the largest percentages. The reason that's so small is if more than 80% of your sellers aren't adjusting their price at all, this indicates that the 20% of the sellers that are taking price reductions would be taking about a 7.5% price adjustment down to get to 15% for 10 to get to 1.5% for the whole marketplace. It gets very diluted, but it's still a valid number. Here is the frequency of those price reductions. So how many sellers are participating? On the San Mateo County coast, you can see that more than half the sellers have reduced their price to get the offer in. It's at 57%. That is by far the highest number up here. Next closest is down here at Oakland at half at 25, and South County at 25. And then from there, you start coming in at 21, 20. But most of the numbers up here are in the lower 2 digits or high single-digit numbers. So again, the number of sellers that are doing price adjustments are fairly small. And I would say the vast majority of them are less than 20% of the sellers are doing price adjustments. So to see almost 60% in the San Mateo County coast, it really stands out. And that's why this is so dark blue, where everything else is red. The other thing you'll notice is more the outlying areas that are starting to do the price adjustments now. The overbidding, this is what buyers are doing. So what are buyers coming and doing? And up here in the city of Alameda and Berkeley is the hottest. Berkeley doesn't show on the map, so it's just showing up in the island of Alameda. It's at 16% overbidding. So that means whatever the seller's asking, on average, the buyers are coming in 16% above that. The redder the color, the more the overbidding is occurring. And you can see that almost everywhere is red on this chart. That's saying that even though we're sort of in a slower market than we typically are in Silicon Valley, buyers are still overbidding. Now, they may be overbidding a little bit less than they typically do. I happen to know the number's almost dead on, so it's just sort of interesting. And this is the frequency of overbidding. So how common is buyer overbidding? And you can see for the most part, you're in Santa Clara County, you're around 70% of the buyers are overbidding. In San Mateo County, because you got these 50 and 42 and 58, it's going to be a little bit lower. It might be around 65% of the buyers are overbidding. And in Alameda County, it's probably somewhere around 70%. Clearly, basically 2/3 to 3/4 of the sellers are receiving more than they're asking on the price when the offer comes in the door. This is the appreciation. It is only since the last 9 months of 2015. I was trying to get a year period of time and I couldn't. And the most common way to measure appreciation is year over year. And that's, in my opinion, garbage, because one year is pretty short when it comes to real estate. Two, a year ago was a low number, then the rate of appreciation this year is going to be higher. So you have two single data points with a lot of bounce. By taking 9 months of 2015, and I was looking for a stable period of time. I was looking for a stable year in pricing to establish the base. And that was to let the market equalize and all that. So you have a fairly solid base. So you're really seeing the fluctuations only on the current end. And you can see the outlying areas, the remote working areas, are sort of having the highest appreciation. It is interesting that the outlying areas in Alameda County aren't doing particularly good right now. I think they went up and then they're coming back down. But right now, the hot areas are basically the Tri-Cities in Alameda County, southern Alameda County, into the eastern slopes of Silicon Valley. Basically, something like east of 87 is sort of where the most appreciations occurred. But the numbers are pretty respectable. 95% appreciation. So you've basically doubled your money in large segments of San Jose. And San Mateo County, where it's lower, you're somewhere basically around 50%. If you bought a house for $1 million, that house is now worth $1,500,000. And most buyers only put like 20% down. So you've gotten 5 times the rate of return on your actual cash investment. So that 50% return becomes a 250% return, which is one of the reasons real estate is such a great investment. One of the reasons the outlying areas are sort of redder in color is because we've had the pandemic between now and 2015. It was in 2020. And so workplace habits have changed dramatically. So people used to pay a higher premium in the peninsula area to be close to work. Because that premium amount has decreased, they've had lower rates of appreciation. And that's why you're sort of seeing the color distribution that you are seeing. Here, the color has nothing to do with, good, bad marketplace. It's simply expense versus affordability. So the blue areas are your more affordable areas, and your red areas are the more expensive areas. The numbers are over here. The middle numbers, the median. I also include the 10 percentile and the 90 percentile so that you can get a range in there. And then down at the bottom there for the key, the median sold price is basically just a little bit under 1.9 million. The 90 percentile is 4.2 million, and the cheapest that you can find a single family home is basically just under 900,000. So in all the cases, the key's on the bottom, and I put in a blank line here to separate it. The threes, like 31 through 37 is Alameda County, 26 through 21 is San Mateo County, and 11 through 17 are micro markets in Santa Clara County. And you should be able to figure these out over here. I think they're fairly uniform. Here's the summary slide of what we went over. I won't go over it, but basically what you can do is come down to an area like the expensive areas in San Mateo County, look across, and you basically are seeing blue, which means that there's a cool marketplace. The areas that are red in color are hot indicators. And even though it's a cool marketplace, sellers in that area, and it's a fairly low number of sample size, only 3% of the sellers were adjusting their price. So once they list their property, they're pretty firm and they just hold it out. And then here would be the price ranges. So you go all the way up to, that looks like $7.5 million, and then the payments. And someone buying $7.5 million home isn't going to do an 80% loan, but if they did, their mortgage payment would be about $54,000 a month. Now we're putting Silicon Valley in a blender, and we're looking at the three key indicators. The indicators here are the purples, the inventory. Where's inventory compared to normal? It's basically about 82% of the inventory you'd expect. So inventory is about 20% of where you'd expect it to be. One reason inventory is low is it's been low, but we also have Labor Day, and Labor Day is early as it can be this year. So it's influencing the data that I acquired through midnight on August 30th, which means the data is actually through the 29th. So I use data through the 29th because of my calendar year, collect the data through midnight on the 30th, reporting it today on the 31st. Offers compared to normal, that's only at 78%. So you have fewer offers than you do inventory. They're both on the low side. Fewer offers gives you a slower paced marketplace because there's less offers and the inventory is higher. So I would expect the DUI here to be closer to 100%, and I would actually expect it to be above, not below. All three data points are taken independently, so it's possible it's just a fluctuation, but I will look into that and try to remember to report back to you, everybody, next week. Here's looking at active inventory. Here, what you're seeing is the gray line is the typical. So that's the 10-year median. The red is the least amount of offers inventory you'd expect, and that's 10% of the inventory. Only 10% of the last 10 years have had inventory this low. 90 percentile, the most inventory you've had is up here. So you can see you have between a normal and a hot or shortage of inventory, and they've been basically following the normal patterns. You can see the holiday impact here on July the 4th. So you're seeing the holiday impact for Labor Day here. Most likely next week, we'll have an influx of inventory going up, and you can see on the normal year, it was here. Now, this year, inventory on July the 4th was more impacted because a lot of people took the July 4th and made it a whole week holiday, so it became a more significant holiday. Here is your inventory compared to the 10-year median. So you're at 80%, which would be a hot marketplace compared to normal. Here is looking at offers. Now, this is pretty telling because here offers are actually below the least number of offers you'd expect. So you're basically having the lowest number of offers in the last 10 years. Now, that may not turn out to be exactly correct, but you're below where the 10 percentile is, which is the blue line. The red line up here is a hot marketplace, which would be a lot of offers. It would be very little inventory and a lot of offers. And this is the typical in the gray line. And here you can see this is this is pulling out the gray line and looking at comparing it to where you normally are. So just a couple weeks ago, you can see you're down around 75%. You now have improved to about 78%. Here's the days of unsold inventory. You can see that we're basically right in the last week, we've crossed over both sides of absolutely typical. We were a little bit cooler than you'd expect. Right now, it's saying that we're a little bit hotter than you would expect, because again, the gray line is where you'd expect the market to be. Here's the gray line pulled out straight. So now you can see we crossed over and we're on the hot side of the gray line, this being down here. But basically the white area is where I call it a sort of a normal marketplace. So right now we're basically having a typical marketplace as far as the speed of the marketplace. Here is the 75th percentile of sellers marketing time. So 3 out of 4 sellers, and you can see that we're very close to the gray line. Yes, you're a little bit above, so a little bit slower. The gray line looks like it actually went up a little bit this week and we went down. So the market's actually cooled a little bit. And we're seeing that by going from a little bit short here to a little bit longer. And again, the fluctuation, you're going to see this because you're comparing this to the 10-year median. Basically, anything in sort of the white is sort of a typical marketplace. When you come down here, you can see that we were on fire, and you can really see the 2022 slowdown. You can see that, basically February 14th, middle of first quarter, we just started slowing down like a rock. And then we finally didn't stabilize at all until basically the beginning of fourth quarter. And then we did a little bit of a bounce. That was a pretty dramatic slowdown. You can see that that's the steepest, longest slowdown that we've had. And it's just because it happened so rapidly. Here's the ask price reductions. You can see that the 10% of the sellers that are taking the largest 10% price reductions compared to the 10-year median, we're almost to the most price reductions you'd expect, but you're pretty close. You're taking way more price reductions than you'd expect. You're up here at 120% and relatively flat. So sellers are taking 20% larger price reductions than you would expect. This is the average price reductions. This becomes a tight metric because now you can see that when we're looking at everybody, that 20% becomes only a 1% price reduction. But the pictures is sort of the same. The thin line up here is the gray line, and you can see that you're on the blue side of the gray line and pretty much following the normal pattern. So at this time of the year, sellers are taking more price reductions, and typically that will continue through about the first month of fourth quarter, and then they decrease a little bit. Here's compared to normal, and so you're taking bigger price reductions, but you're pretty much following the normal pattern because this line's pretty horizontal. The normal line would be right up here, and you can see that even in a hot marketplace, sellers take a little bit of a price reduction, but you can also see that for very short periods of time, there's 3 of them for the last 10 years, sellers actually raised their price slightly in these 3 little peaks. Actually, there's a 4th one right there that I didn't notice. Here's the frequency of those price reductions. So the frequency is right on normal. The number of sellers participating in price reductions is exactly where you'd expect it to be, but they're taking bigger price reductions than they typically do to give you that average price reduction that was larger. It's not more frequent, it's larger magnitude. Here you can see that compared to average, the frequency is right there on the gray line, which would mean that the commonality of price reductions is exactly where you'd expect it to be. Here's the overbidding. So now we're looking at the magnitude of overbidding of the buyers. And again, you can see we were way above where you'd expect it to be. We came down, we were right on where you'd expect it to be. And now you're just slightly above, and we turned around and went up this last week. 1 week up, it could be a data fluctuation, or it could become a trend. Basically, you need 3 data points to really start establishing a trend. Otherwise, you could have just little corrections like that on the way down. You can see there's bounces, but then there's also data points where it turns and then changes abruptly. I suspect, based on the pattern here of lines typically going down, I would expect this to change and possibly go down even as early as next week. So here you can see the range. We were basically right on normal for the couple weeks. Then we improved a little bit. Here's the frequency of overbidding. So how common is overbidding? And for the 3 counties, all of Silicon Valley, you can see it's about 2/3 of the buyers that are writing offers and getting offers accepted are going over the ask price. So even though some people are saying the market's slowing down, and I would be one of them, still 2/3 of the buyers are offering the seller more than the seller's asking. Here is, and that's a little bit more than normal. It's about 4% more frequent overbidding than commonly is. Here's your price on log paper. So the blue thin line is sort of the rate of appreciation. You can see 2 patterns that I think are key is the V dip at the end of every year. And remember, this is based on closing. So the actual market activity happened basically 3 to 6 weeks earlier than it's being reported, but you need the sale price to do it. The other flip is you have this overshoot basically in sometime in second quarter of every year. Now in 2020, with the pandemic, so many people's housing needs changed. We really didn't have the normal pattern. It was basically flat. But you can see this year, the current year, we went down at the beginning of the year. We went way up, and now we're coming down. So I'd expect this to go down and turn around and go back up next year. If you have flexibility, when you buy a property does matter, because if you purchase the property and close basically down here on January of 2024, you're only paying 1.4 million. In theory, you would have bought the same house for 1,750, 1,750,000, or 350,000 more just a quarter and a half later. That's only 4.5 months later. Now, again, you're turning around. Now you're back down to only about 1,550,000. So now you're only up somewhere around 150,000. So if you could buy here versus here, you're doing yourself a whole big favor. And that's part of the reason I do the amount of detail I want, so I can advise clients when they want to be aggressive in offers, when they want to be aggressive in list prices, sellers, when they want to try to time their purchase if they have flexibility. Here's your PITI payments. The gray line is the median price home for Silicon Valley. The red line is the most expensive 10% home, 90% home at $24,000 a month payments, and the most affordable areas down here, I would guess that's about $6,400 a month payments. And you can do better than that by borrowing jumbo money. Jumbo money is cheaper than conforming money. It doesn't make any sense. You can also do an adjustable rate loan. Might also have retirement or stock that you don't want to cash in, that you can get relationship pricing from banks. Here's a summary slide. You're basically looking at inventory. The gray line is where you'd expect inventory to be. The purple line is actual inventory. We went from 88.9, and this is only for the last 14 weeks, which is 1 quarter. So we went from 89% of inventory to 81%. So we lost 8% of your inventory, but the number of available inventory is basically unchanged, 23, 21, 23, 40, 34. So the level of inventory hasn't changed, but inventory, the typical inventory has gone up a little bit. So the percent of the current level of inventory has gone down a little bit. Offers accepted. Offers have dropped from 2,400, almost 2,371 down to 2,077, but the percent of offers accepted is almost unchanged. It dropped a little bit from 78.6% down to 77.5. So I would call that almost unchanged, but yet it's a fairly tight metric. So you can see that you went from above the blue line, even though it's measured from the gray line, to below the blue line. So you went from slightly more, and maybe the more global way of looking at that, you went from right on the least amount of offers accepted to below the least amount of offers you'd expect. So we're having a shortage of offers. DUI went from 34 days to 40 days. So it slowed down 6 days, which is a slowing of the marketplace. But at the same time, compared to normal, we went from 111%, which is a slower marketplace than normal, which is why the purple line is above the gray line, to a faster than normal marketplace. So the market's normally slowing more than it slowed this year. So even though we're slowing right now, we have slowed less than we typically do. Look at what happens on marketing time, though. We went from 14 days to 25 days, taking almost double, 11 days out of 14 longer to sell. And you went from less time than normal, from 85% of your normal time to sell, to 106% to more than normal, which is why you're above the gray line. So most of the quarter, you've been on the gray line, but at the very beginning of the quarter, we were taking less time than normal to sell. Right now, we're taking slightly more time to sell. Price reductions for the last quarter. Basically, you went from 2/3 of 1% price reduction to a 1% price reduction. So we're taking a bigger price reduction, but the percent of normal is basically unchanged. 132.5%, so 32.5% more than normal, to 33.4% more than normal. And you can see the distance from normal is roughly unchanged. What that's saying is the sellers typically, based on the past 10 years, are taking a larger price reduction at this time of the year, Labor Day, than they were 14 weeks ago. And overbidding, what are the buyers doing? Well, we went from 9.4% down to 5.7%, and they went from, that was 2.6% more than they typically overbid, to only 0.7%. The buyers have dropped 1.9% more than they normally drop at this time of the year. So it normally drops, and it dropped more this year. So here's your inventory compared for the 3 counties. So Santa Clara County is in the blue, Alameda County is in the gray, and San Mateo County is in the orange. San Mateo County, if you look back on itself, has roughly the same amount of inventory it typically does. Santa Clara County is the shortage because Alameda County and Santa Clara are typically very close together, and now Santa Clara County has less inventory than Alameda. As far as normal, San Mateo County is normal, followed by Alameda County being next normal, and then Santa Clara County having the biggest shortage. This is offers accepted. You can see offers accepted. San Mateo County is a little bit below where it typically is. Santa Clara County and Alameda County are very close together, but still below. And Santa Clara County had less inventory and selling more homes. So Santa Clara County is going to have the fastest market out of the 3 counties. Here's your days unsold inventory. Santa Clara County is down there at the fastest because it's the lowest. San Mateo County is actually second, and Alameda County is the slowest. And that's going to be interesting coming up, time on the market, Alameda County the slowest, San Mateo second, and Santa Clara County the fastest. Here is where it's going to get interesting because Santa Clara and Alameda County have the same amount of price reductions. San Mateo County has the most price reductions at 1.5%. The frequency of price reductions, Santa Clara County is the least frequent at somewhere around 14.5%. San Mateo and Alameda County are very close together at the same and somewhere around 17%. But here's what's interesting. Alameda County has the most overbidding. So even though it's the slowest marketplace, it's got the most overbidding, followed by San Mateo County, and then Santa Clara County has the least amount of overbidding, even though it was the fastest marketplace. Here's the frequency of overbidding. Santa Clara is the least frequent overbidding. Alameda County and San Mateo County are basically tied. Here's the rate of appreciation. Santa Clara County has the highest appreciation. San Mateo County has the lowest. Alameda County is slightly better than San Mateo County. Here's the price. You can see that San Mateo County is below where the price was in 2021. Santa Clara County is above, and Alameda County is slightly below, but very close to where it was in 2021. Here's your price on regular paper. The previous was on log paper. Here's the estimated payments for the 3 counties. Here's the table of the data, so you can come back, and the big thing here is showing the lack of inventory. We're the 9th slowest year out of the last 10. We're the 23rd slowest year out of the last 25. Here's the actual raw data if you want to come look at it. We've been talking about Silicon Valley real estate market analytics, and we will be talking about the Greater Bay Area in 13 counties and 5 regions shortly. To get to a past episode, you type in the blue URL for YouTube. That's the YouTube channel. Or you can type in the shorter green root URL. If you want to join the presentation live Saturday morning, you can type in the green root URL plus the year we're in, 2024. And if it asks for the passcode, it's there. You'll be able to listen to the presentation live Saturday morning and ask questions if you have any. If you'd like the handout of this presentation, the PowerPoint slides, just add in the green root URL plus H for handout 2024-08-31 for today's date, and you'll get that 66-page slides. If you want a specific past episode, the green root URL, the year, month, date code of what you're looking for, or you can go to the YouTube channel directly and pick any week you want. I'm Richard Calhoun, real estate broker here in Silicon Valley, working with buyers or sellers. Happy to discuss your real estate needs and how this data can be applied to make your investment a better investment. Open for any questions. Not seeing any unmuted mics. I'll move on to the Greater Bay Area. The Greater Bay Area includes 5 regions. The first region is Silicon Valley that we've been talking about. The second is the cities, San Francisco and Marin. The third is North Bay. North Bay is Sonoma, Napa, Solano, and Contra Costa County. Then you have the Central Valley, which is San Joaquin and Sacramento counties. And then you have the Central Coast, Santa Cruz, and Monterey counties. And this is for single-family homes only. Active inventory on these graphs, you'll notice I have the 5 regions on here. From 2014 through January 1st of 2023, I'm on a condensed horizontal x-axis, and that's so that you can get 10 years worth of data. From January 1st of 2023 through current date, it's expanded. It's a little bit more than double the distance. And the reason for this is so you can see smaller changes. I have 2023 for a complete year, so you sort of can see the cycle. And then the current year, 2024, is just year to date. We start off with San Francisco, the cities. It has the least amount of inventory at somewhere around 500 listings. Then you have Central Coast, which has about 800 listings. Then you jump all the way up to Silicon Valley, which has about 2,150 listings. The Central Valley is about 2,800. And the North Bay is just over 3,000, probably about 3,025. You can see inventory is flat in 3 regions and climbing in the Central Coast and in the Central Valley. Now you're looking at the number of offers. Offers are basically climbing in all areas, although both the cities and the Central Coast are pretty flat. There's just a slight incline to the slope, followed by Silicon Valley's climbing a little bit, but really climbing is North Bay and the Central Valley. Those are significant increases in the last, what would it be, about last 6 weeks. We've gone up by a significant amount. For example, Central Valley has gone from some number around 1,375 probably up to almost 1,800. and the North Bay has gone from some number around 1,500 to 1,850. You know, significant gains. You can see the slope. It's basically the rate of climate seen since the beginning part of the year after the little bit of dip. So it's still climbing, where Silicon Valley's dip is a little bit more severe and the climb is clearly less than the climb early. Silicon Valley really takes a spike up after the first of the year. Speed of the market. Silicon Valley is the fastest, Central Coast is the slowest. The other three are pretty close together, with the cities being the second. So you have San Francisco, you have Silicon Valley, the cities, then tied is North Bay and the Central Valley, and the slowest is the Central Coast. The time on the marketplace, which is basically the same thing, but just a different way of looking at it. The fastest area is Silicon Valley. Here, the Central Valley is next, and the cities is tied with the North Bay and the Central Coast. So you have three that are basically all tied for last place. You can see that you do get slightly different answers based on numbers that you'd expect to be very similar. Ask price reductions from the seller. The area that's taking the biggest price reductions is the Central Coast. They did a huge drop at the beginning of third quarter. It looks like that might be reversing direction a little bit. Most of the regions are going down. The one exception that I would see is the cities is seeing a reduction in price reductions. Basically, at 100%, sellers aren't adjusting their price down at all. At 1%, which is Silicon Valley, they're at 99% of their original last price, so they're a 1% price reduction. The Central Valley is next at 1.4% price reduction. Cities has turned around and come up to 1.6%. North Bay is 1.8%, and the Central Coast is 2.5% price reductions. Frequency is how common is the price reduction. They're least in Silicon Valley, followed by the cities. Then they're pretty much tied together. But even though the Santa Cruz, Monterey, the Central Coast had the largest amount of price reductions, it's not that frequent compared to the North Bay and Central Valley. So there's more sellers taking price reductions in the North Bay and the Central Valley, but the price reductions that are a little bit less common in the Central Coast are much bigger, so that the average decrease in the Central Coast is larger than the average decrease in Central Valley and North Bay. Now you're looking at the magnitude of overbidding. So looking at the magnitude of overbidding, this is flipping over and seeing what the buyers are doing. The most amount of overbidding is Silicon Valley, but very close on its tails, basically tied, is the city, San Francisco and Marin. Then there's a huge drop from somewhere around a 5.5% overbids down to North Bay. It's just under 1%. Central Valley is right at asking price, and Central Coast is about a 0.5% price reduction on average. This is the frequency of overbidding. So how common is it? Not as least common in Central Coast, where basically somewhere around 36% of the sellers are getting overbid, followed by Central Valley at 42%. The North Bay is next at about 45%. Cities is just over 52%, and Silicon Valley is the most amount frequent of overbidding at somewhere around 67% of the sellers. 2/3 of the sellers are getting more than their asking price. Here's total appreciation. The cities has had the least amount of appreciation, and they're doing these huge cycles, which is just interesting. It's clearly taken a hit since the pandemic, and it's gotten the worst. You can see that prior to the pandemic, all 5 regions were very close together. Yes, Silicon Valley had a couple of exceptional years with better appreciation, but then it caught up. But since the pandemic, the cities has been doing very poorly, and right now is basically somewhere around 24% appreciation. You compare that to the Central Valley with the longer commutes and more flexible work schedules, has about 91% appreciation, so more than 3 times the appreciation rate in the Central Valley. And in between, you have Central Coast is second place, again, a more remote. Silicon Valley and North Bay is in the 4th place out of 5, with the cities, San Francisco and Marin, being the worst appreciation. Here's your prices. Silicon Valley is now more expensive than the cities. That is a reversal. You can see before the pandemic, the orange, the cities was quite a bit higher. With the pandemic, they got closer and closer together. We were pretty even most of 2024, And in the recent weeks, the cities in Marin has continued to drop, and Silicon Valley has basically done a plateau, if not, or a slight reversal. Central Coast has done a little bit of a reversal. Central Valley is basically plateaued, and I would say that the North Bay is still on a slight decline. Here's the payments for the different regions, and because Silicon Valley is more expensive, their monthly payments, and this is assuming an 80% loan at the federal rate for jumbo conforming money. If you go all the way to jumbo money, you get a lower interest rate, and if you do an adjustable rate loan, you get a lower rate. And if you have other assets that you can establish a relationship pricing with the bank, you get better rates. Central Coast is in the middle. Then you have North Bay, and the most affordable area is the Central Valley at just about $4,400 a month EITI payment. Here's the actual numbers, so you can look at the different metrics up on top. You can look at the different 13 counties. I also, in addition to the 13 individual counties, I put in Silicon Valley, since we talked about that at length, and I also put in the 9 Bay Area region, and I put that in there because the media talks about it. I think it's really a garbage number. Pick any one of these numbers that you want. Let's just pick days on market, 38 days for the Bay Area, but what's the range? The range is all the way from 57 days to 22 days. So in Santa Clara County, you're at 22 days, where in Sonoma, the 3/4 of the sellers take 57 days, 3 times longer almost. Actually, it is 3 times longer. There's the 66. So you go to Napa and it's 3 times longer. And if you're taking 3 times longer to sell, the market's completely different. They're accurate numbers when you talk about Bay Area real estate, but it really doesn't tell you what's happening in any given county. And then even when you get down to the Silicon Valley, where I do most of my business, Santa Clara, San Mateo, and Alameda County, even each county doesn't tell you what's going on in the marketplace, which is why I broke it down into 20 different micro market areas. And here's a summary of those 20 micro markets areas. With that, we're pretty much finished for the week. I'm not seeing any unmuted mics. And take care. See everybody next week. Bye for now.